unaudited Q1FY26 earnings conference call. As a reminder, all participants' lines will be in listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during this conference call, please signal an operator by pressing star then zero on your touchtone phone. Please note that this conference is being recorded. I now hand over the conference over to Mr. Suyash Samant from Stellar IR Advisors. Thank you, and over to you, sir.
Thank you. Good afternoon, everyone, and thank you for joining us today. I have with us today the senior management team of Baazar Style Retail Limited, Mr. Shriyans Sunara, Managing Director, and Mr. Nitin Singhania, Chief Financial Officer, who will represent Baazar Style Retail Limited on the call. The management will be sharing operating and financial highlights for the quarter ended June 30, 2025, followed by a question and answer session. Please note, this call may contain some of the forward-looking statements which are completely based upon the company's beliefs, opinions, and expectations as of today. These statements are not a guarantee of the company's future performance and involve unforeseen risks and uncertainties. The company also undertakes no obligation to update any forward-looking statements to reflect developments that occur after a statement is made. I now hand over the conference to Mr. Shriyans Sunara. Thank you, and over to you, sir.
Good afternoon, everyone. Welcome to our Q1FY26 earnings call. Our presentation has been uploaded to Stock Exchange and the company's website, and I hope you had a chance to go through it. We are pleased to report that our strong growth trajectory has continued in Q1FY26, with revenue reaching 378 crores, an increase of 37% year-on-year and 9% quarter-on-quarter. Gross profit also demonstrated healthy traction, rising to 136 crores, reflecting a 49% growth year-on-year and 19% sequentially, with healthy margin at 36%. I would like to provide an overview of the current trajectory of our performance and share our outlook for the upcoming quarters. We remain on track to achieve our FY26 guidance and are confident of delivering a revenue growth of 25%. While we prefer to wait and assess the performance of the Q2, especially given the significance of the Durga Puja festival in East India, before considering any revision to our guidance, it is important to note that the underlying demand on the ground continues to remain strong. A revised outlook, if any, will be shared post completion of H1. We expect to deliver SSG growth of 7 to 8%. Pre-Ind AS EBITDA margin is projected to be at 7 to 8%, while Pre-Ind AS PAT margin is expected to be 3 to 4%. Additionally, we reaffirm our guidance of opening 40 to 50 new stores during FY26. We anticipate a meaningful uptick in demand during Q2 and Q3, driven by the festival season, including Raksha Bandhan, Durga Puja, Diwali, and the wedding period, which traditionally spur consumption and reinforce our confidence in the outlook. The company's strong execution capabilities, established regional leadership, and focused long-term growth strategy continue to underpin its robust growth trajectory, driven by the following key factors. 1. Our focused business strategy on value fashion in the under-penetrated eastern region has enabled us to benefit from the shift from unorganized to organized retail, supporting our steady growth. Second, our product offering across categories remains a key strength. By providing a one-stop shopping experience for the entire family, we are increasing customer convenience, footfall, and basket size. Third, our cluster-based expansion approach supports operational efficiency by enabling better site selection, improved understanding of the catchment area, and faster ramp-up of new stores, leading to quicker economies of scale. Fourth, our continued focus on private label is yielding strong results. In Q1 FY26, our portfolio of private labels has contributed 61% to the revenue, amounting to 229 crore, reflecting a 59% year-on-year growth. Notably, our brand Square Up recorded its highest ever quarterly revenue, contributing approximately 99 crore. Our expansion journey continues, with the total store count in Q1 FY26 reaching 232, a 40% year-on-year increase, and the total retail area now stands at 2.11 million square feet, reflecting a 41% growth over the previous years. Now, before coming to the profitability, I would like to take a moment to provide you with a brief overview of how our business operates. As a value retailer with a strategic presence in Eastern India, our demand pattern is inherently seasonal, driven by regional specific festivals that occur at various times throughout the year. Accordingly, our performance is most appropriately assessed on a full year basis. For instance, in Q1FY26, SSG appeared muted as Eid sales were advanced and captured in Q4FY25. However, after adjusting for the 15-day shift, the normalized SSG for Q1FY26 stood at a robust 11%. Therefore, evaluating SSG on a year-to-date basis provides a more accurate and meaningful representation of performance. The company remains in a strong expansion phase, strategically investing in scaling operation to increase store count with net addition of 18 stores in Q1FY26 and enhanced technology integration. While growth-related investment may temporarily impact operating margin, the company continues to deliver healthy absolute financial growth. Now coming to the Q1FY26 financial and operational highlights. As mentioned earlier, we believe that the pre-Ind AS view provides a clearer reflection of our underlying expenses and profitability. For this discussion, we will be referring to the financials on a pre-Ind AS basis for greater clarity. In Q1FY26, EBITDA for the quarter was 25 crores, up 14% year-on-year and 114% quarter-on-quarter. Profit after tax came in at 9 crore, representing a year-on-year growth of 531%. However, it is not comparable on Q-on-Q basis due to a low base in Q4FY25. In terms of key operational metrics, pleased to share that our focus market states have performed well. In Q1FY26, we achieved a growth of 73% year-on-year and 24% quarter-on-quarter, with revenue reaching to 72.6 crores. Average store size stood at 9123 square feet versus 9037 in Q1FY25. Average transaction value stood at 900 versus 955. Number of bills stood at 4.48 million, up 45%. Quantities sold 15.06 million, up 46%. Sales per square feet at 663 versus 661 in Q1FY25. SSG stood at -3%, whereas normalized SSG stood at 11% due to the preponement of Eid, as explained earlier. Additionally, inventory days were reduced to 116 days in Q1FY26 compared to 120 days in Q1FY25. Trade payable days stood at 111 days in QYFY26 from 163 days in QYFY25. In summary, we are strengthening our market position by expanding our store network in core and focus regions, investing in supply chain and talent to enhance efficiency, and growing our private labels to build differentiation and trust. Operational improvements through technology, data analytics, and our omni-channel models are progressing well. With the anticipated festival tailwinds in the upcoming quarters, including Raksha Bandhan, Durga Puja, Diwali, and the wedding seasons, we remain confident in delivering a strong performance and achieving robust growth in the quarters ahead. With that, I would like to conclude my opening remark and request the moderator to open the floor for questions. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone phone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Gaurav Jogani from JMFL. Please go ahead.
Thank you for taking my question and congratulations on the strong set of numbers. So Ajay, my first question is with regards to the other expenses increase. Now, even if we look at on the pre-Ind AS basis, there is a sharp increase in the other expenses. So can you please help us out how these other expenses should be looked into going ahead, and if there is any one-off in the other expenses line item?
Thank you, Gaurav. As we continued in our expansion phase, several costs has been strategically front-loaded to support the future growth. And this increase in cost is aligned with our growth strategy. We have added more stores, invested in hiring, upgrading our warehouse infra, and increasing customer engagement program to drive footfalls. With revenue projected to rise, particularly during the festival season, their proportion relative to top line will decline, driven by operational leverage and economies of scale. This means incremental gains will fully drive EBITDA improvement, fueling our margin expansion and operating leverage. In terms of number, in FY25, our average operating cost stood at around 180 rupees square feet, which in Q1 FY26 stood at 183 rupees per square feet. We expect this average operating cost of around 180 square feet to hold during the entire financial year. And as I have said that with the strong quarters ahead, we expect a good sale per square feet. And so the entire thing will translate to EBITDA only in terms of margins.
Yeah. So Shreyansh, just one clarification. When you say 180 per square feet, that is on a quarter-on-quarter. That is for the quarter or a monthly basis.
Yes. Yes. On the monthly basis. It's the average cost of 180 rupees per square feet.
Okay. And this would be including staff costs and other expenses?
Everything.
Okay. So you said that is expected to remain in this 185 rupees per square feet kind of a range, right, for the year?
Yeah, for the year.
Okay. And on the gross margin side, the gross margin has seen a very healthy expansion this quarter of around 300 plus bips. So what is the guidance, if any, if you can provide on the gross margin front?
So see, the gross margin was higher largely because of the full price sale through that we have achieved. But I think the things will get normalized in the upcoming quarter, as there will be a festival season promotions rollouts along with the EOSS in the month of July. So I believe after all the seasonal adjustment, we anticipate a margin of up to 50 basis point increase by I will say because of the inventory efficiency and because of the private labels for the entire year.
Okay, so would that mean that in the remaining 3 quarters, the gross margin would decline? So if you're saying for the 50 bps for the entire year?
So it will not decline quarter but the sales would be higher, and maybe for the Q2 and Q3, the margins which we have achieved last year, so it will be on a similar lines or on a little bit of increase. So the increase that Q1 saw, it will not be the similar increase which Q2 and Q3 will see. So as because of the higher revenue contribution over there, so as a percentage it will reduce, but again from last year it will be higher by 50 bps.
No, so that is the thing. I mean, if you look at the Q1 margins, Q1 gross margin is expanded by 300 bps. Okay. Now, if I take for the entire year only a 50 bps gross margin expansion, so would that mean that for the remaining 9 months, from Q2 to Q4, there would be a decline in the gross margin, because only then would a 50 bps margin would justify for the entire year.
During the EOSS, the margin will decline, but during festive and other quarters, it will be in similar lines to last year.
So Gaurav, what is happening is that for Q2 and Q3, if you see the numbers are very high in terms of revenue. So what will happen for the Q2, Q3, maybe the margin will be similar to the last year's only. So for the full 9 months, on an average, this 3% may become 1% higher for the first 9 months, and for the last quarter again there will be an USS on the January. So when the quarter 4 ends, it will be typically higher by 0.50 bits. This is what our assumption has been around this thing.
Okay. Sure. So I'll come back in the queue for more questions. Thank you.
Thank you. The next question is from the line of Palash Kawale from Nuvama Wealth. Please go ahead.
Yeah, thank you for the opportunity, sir, and congratulations on good set of numbers. Sir, what was the rental for Q1?
Rental cost is 56 rupees per square feet.
Okay, and what do you expect it to be for the full year?
It will be in similar lines only. It will be hovering around 56 to 57 rupees only.
And sir, what was it for the Q1 last year?
It was 53 rupees.
Okay. And sir, any update on the insurance payment that you are supposed to receive?
See, in terms of insurance payment, we have received an amount of 3.48 crores, including salvage value, against the total asset loss of 4.24 crores. For the inventory thing, we are actively and consistently engaging with the insurance company to expedite the claim processing. We have submitted all the documents to the full extent of the inventory loss. I think given the complexity of the assessment and settlement process, our resolution timeline is still under progress, and we remain optimistic because we have submitted all the requisite documents as discussed with the insurance company, and we expect the matter to be settled in the upcoming quarters. and we'll continue to keep you informed of any significant development regarding the inventory claim.
Okay, sir. Thank you so much. That's it from my side. Yeah.
Thank you. The next question is from the line of Rehan Syed from Trinetra Asset Managers. Please go ahead.
Yeah, good afternoon to the team and thanks for the opportunity. Sir, I have a question regarding the technology and supply chain side. So with the recent appointment of a new AVP for supply chain, what structure or digital improvements are being planned for back-end efficiency or inventory optimization? And how are you leveraging tech for improving inventory turns and reducing stock outs across tier 3 and tier 4 locations?
So I just missed the first part of your question. Can you just come again with the question?
Sure, sir. Sure. With the recent appointment of a new AVP for supply chain, what structure or digital improvements are being planned for back-end efficiency or inventory optimization?
Okay, so in terms of, because this year, I've got told in last call also that this year has been a year of tech for us, what we have taken. So in terms of supply chain, we are just on the phase where we will be implementing the Infor warehouse management solution, and which will be live by month of November if everything goes smooth. On the inventory side, we are working on a ARS called Gold Red, which works on theory of constraint, and I think their implementation has also started. So I think which will lead to a faster supply chain structuring, which will again increase the inventory turn, and we expect the numbers to look visible by this year financial year itself. We will be able to see the technological benefit that will be derived from these implementation of these softwares. Apart from that, the entire backend ERP, we are planning to shift it from Genesis to SAP HANA Retail. I think all these measures will help us to improve our supply chain.
Oh, okay, sir. Okay. And sir, I just want some more clarification regarding sir, what is the average payback period for new stores opened in the last 12 to 18 months, especially in the underpenetrated geography?
More or less, the geography, for example, core and focus, I will say in that way. So on an average, on the capex side, it takes around 18 months to recover, and for the entire investment, it takes around 31 to 33 months for the recovery. In terms of focus market, the focus market performance has been good, but still, if you compare to core market, it will take additional 2-3 months maybe extra, because that is the states where we are developing our market. But yeah, I think gradually, maybe a year later, when that focus also shifts to core, it will come to similar numbers.
Okay, sir. Thank you for clarification. If I have more questions, I will come.
Thank you. The next question is from the line of Natik from NV Alpha Fund. Please go ahead.
Hi, sir. Congrats on a good set of numbers, and thanks for taking the question. So my first question is, if you could give us the debt on the books as on date and cash flow from operations that we have generated after paying lease during the quarter.
So total net bank borrowings as on date for the Q1 is 157.43, which we have already stated in the last earning call that it will be gradually reduced and will be around 120 CR
at the end of the financial year.
Right. And what will be the cash flow generated post lease for the quarter? Cash flow generated from operations post payment of lease.
It is around 26 CR after adjustment of lease payment.
Right. Got it, sir. So my second question is, the 183 per square feet other cost you mentioned, that includes rental cost also?
Operation side. Both rental, employee cost, and all the other expenses, excluding depreciation and interest.
Right. Got it. And so my last question is, what is the corporate expense as a percentage of sale for us?
It stands at 6.15% for this quarter.
Got it. That's it from my side. Thank you.
Thank you. The next question is from the line of Chirag from Keynote Capital. Please go ahead.
Yes, thank you for the opportunity. Congratulations, Shreyansh and Nitin for the great set of numbers. My first question is that you have mentioned that in Q1 our full price sales was better. Could you just give me a number? What was the percentage of full price sales for Q1 FY26 and FY25?
So 92% was the full price sales growth in Q1 FY26 against 89 in Q1 FY25.
Okay. Second thing I would like to know that our payable days is around 4 months, if I'm not wrong. Could you just let me know is this one reason if we improve our payable days to like 90 or 60 days going forward, can it become incremental on our gross margin? If that is the strategy or not, that if you could just highlight that too.
See, you can say yeah, there will be a benefit in the gross margin once we reduce it. But yeah, I think with the growth that we are aiming, we want to reduce it to 90 days just so that the sourcing becomes easier for the manufacturers also. And whatever, if they are able to earn on their sourcing, they will transfer it to us, and we would like to transfer it to the consumer. So that the entire chain becomes is on the value side only. We don't have to increase the prices, and there will be a little bit impact on the gross margin also with that.
Right, fair point. So can I expect that with improvement in tech that we are working on, this numbers is expected to gradually go down to 90 days by FY27 or 28? Hello.
Yeah, yes, you can expect by FY26 and FY27 you will see the numbers gradually going down, and it will be around 90 days as you said.
Perfect. So my second question is related to store level warehouse size as a percentage of entire store size.
We generally don't have the back-end warehouse as such, so it is generally 200 to 300 square feet of back-end space for keeping the material.
At the store level.
Okay, and the number of days inventory that we keep in warehouse?
So totally depends on season to season. So for example, because we are majorly our revenue comes from the festival-driven seasons. So as I have told in the previous call also, the inventory looks higher before any festival starts, and it looks lower when the festival or the season ends. So at the maybe when the festival is on the full run, the inventory per square feet at the store level goes up to 2,500 rupees also, and when the inventory at the end of the season, the store inventory comes down to around 1,700 rupees. So that is the volatility before and post any festival season.
You mean per square feet? What are you talking about when you say?
Yeah, per square feet inventory. So I will just tell you, for example, on 31st March, our inventory was at around 2,700 rupees square feet, which has come down to again 2,092 at June end.
Got it. Perfect. So my next question is that as you said that our corporate expense as a percentage of sales is around 6% today. What kind of stable EBITDA margin pre-Ind AS basis we can expect down the line 3 years, like, because this expense is going to showcase some operating leverage, of course. But could you just highlight at current SSSG what we have around 7 to 8%? What kind of EBITDA margin on pre-Ind AS level we can do?
So see, this year, as I said, the guidance is 7 to 8%. Last year, the entire year corporate overhead was around 5.7%. And typically, I think there will be an operating leverage. And in next 3 years, with the operating leverage kicking in, with the gross margin and the full price through, with all this tech thing that we have done, is going to improve, will help us to achieve a EBITDA of 9 to 10% by FY28. So 7 to 8 this year, 8 to 9 next year, 9 to 10 maybe the FY28 numbers.
And keeping SSSG in mind of 7 to 8% only, right?
Yes.
Perfect. That is it from my side. I'll join back with you. Thank you so much.
Thank you.
Thank you. The next question is from the line of Gaurav Jugani from JMFL. Please go ahead.
Hi. Thank you for taking my question again. So my question, again is with regards to the other expenses per square feet trends. So if I look at the base quarter, the other expenses per square feet was around 154 rupees, and this quarter it is around 183 rupees, as you mentioned. Now, if I look at for the remaining the remaining 9 months, the expenses have only increased from there on. So, what will drive, given that the festive is also coming, that you will also have higher activity levels. So do you think that it can remain at this 183 levels?
If you see the last 3 quarters, Q2, Q3, and Q4 of FY25 also, it was around 187, 188, and 184. And this quarter it is around 182. So technically what has happened, all the cost that has been front loaded last year, okay, and with the growth in revenue, so it will not be increasing that much. It will be at the same tune, because all the expenses that has been increased, we have taken that hit last year itself. So the 180 base has been created, and that base is only going for the quarters.
Okay, got it. So it is largely the leverage now kicking in these line items, right? That will benefit.
Correct.
Okay. And on the rental also, I mean, while optically it seems that, the rental, as sir mentioned, Nitinji, that, it's been around what? So that will be including the rental on the pre-Ind AS number. What will the total rental actually on the pre-Ind AS number? If you can give us that number, that will be helpful.
56 per square feet will be the numbers which will be around for the FY26 also. And for Q1 it is around 54, so on the similar lines.
Okay, and has this gone up because we are opening higher square footage stores, or any other reason for that one?
The first thing is, the rental is a byproduct of where you open the stores, because in the last financial year there are a lot of stores which has opened in tier 1 and metro cities, which has a higher rental as a cost. I think the mix of all these things has impacted the rent per square feet that way.
Okay.
Because larger chunk of stores have been opened in the metro and tier 1 in last financial year. As a result, the rentals are showing at 54 for this quarter 1, which is not very high. If you see from Q1 FY25, it was around 45, which has increased to 54 for the stores, and that is majorly because of the stores opening in metro and tier 1.
Okay. And sir, given that this time around the festive season is in Q2, and last year I think it was a mix of Q2, Q3. So do you see some benefit accruing in Q2 itself this year?
Yeah, we will have an uptick in demand because of the early festival. So 11 days shift from Durga Puja from Q3 will happen into Q2, which will have impact on higher sales from Q2.
Okay. And lastly, on the capex front, what is the capex guidance for this year and the next year?
1390 to 1350 per square, 1390 to 1400 per square feet
for the store openings.
Okay, so can you give me the total? I mean the maintenance, capex, and everything. What kind of?
Everything it will for everything it will be around 90 to 100 crore for this year.
90 to 100 crore.
With all the tech and everything, all the costs of the warehouse infra also have taken, back-end operations, everything put together.
Sure. So because there will be a good savings in terms of our inventory also. I mean we don't expect the incremental drag from the inventory. So would that mean that could help in better cash position this year versus last year, given that there will also be a better profitability and lower outflow in terms of the working capital?
Yeah, you can say so. Apart from that, because I think this year we will be also having the insurance receivable as one of the cash flows inflow for this year. So I think with that plus internal accruals, will help us, will give us a better cash flow from last year.
Okay, sure. Thank you, and that's all from me. Yeah.
Thank you. The next question is from the line of Raj from Fident. Please go ahead.
Yeah, hi. Thank you for the opportunity. A couple of questions from my side. Firstly, again on rent. So rent quarter-on-quarter saw close to around 18% growth. So I wanted to understand the reason for this. Is it only because of the new stores, or in the existing stores as well, are we seeing some the increase in the rental cost mainly because of competition? So how is the competition panning out in this industry right now? Because everyone is quite aggressive in store openings.
So see, in terms of rental with the existing stores, because we are having an agreement with them. So whatever as a part of agreement, every 3 years there is an incremental clause, 12 to 15% depending on landlord to landlord. So that is taking place. There is no extra rental. Yeah, as I said that because a lot of store openings have happened in metro and tier 1, which typically has a higher rental compared to tier 3, tier 4 cities. So that is one of the reasons. And at the back end, last year versus this year, in last year the Q1, the warehouse that we were having was only 86,000 square feet, whereas this year in Q1 the warehouse that we had was around 1.86 lakh square feet. Similarly on the office space, so there were a lot of expenditure at the back end also, which has increased for the supporting the future growth. I think that is why the per square feet as a percentage, as you can see, the rentals have increased. But as I said that this will be the trend for the entire year, and in tier 2, tier 3, because of our expertise in the zone, as we follow the cluster based approach, is better than any other players. As a result, we are able to check out the areas where we want to open the stores at the similar rentals that I said. Between that is why I said the entire year average will be around 56 only.
Okay, and so what, sorry, you said there was some 12 to 15% of rental cost increase in the agreement each year. What is that number?
So every 3 years, it is around 12 to 15%. It's an average. This is standard agreement with every retail player. So between 12 to 15%. So 15% is the standard for tier 2, tier 3. And there are some agreements which is only 5 to 10%, which has 12% increment every 3 years.
Okay, understood. And so secondly, the other players are also mentioning that in West Bengal there is some pressure in terms of demand, mainly because the influx of people from the neighboring countries has completely stopped. So how are you seeing the situation on ground in terms of West Bengal?
So see, in terms of numbers target that we have taken, we have been able to achieve that number. I think the numbers would have been better if the flow from the neighboring country was there, because there are some pockets in Bengal, where the sales are very good because of their when they come during the festival seasons. But this year, because of the government policy and whatever the reason, they have not been able to come into shop. So I think these numbers are without there, and we expect as the things between both the neighboring countries gets good. I think in the upcoming quarters, with the strong festival quarters that we have, if their inflow starts again coming back, we will be having higher numbers. As a target, we are meeting the target that we have set. So for us, we have met the targets in Bengal, whatever we have taken. Yeah, we could have done better if their inflows were there.
Thank you. Thank you.
Thank you. Ladies and gentlemen, please limit to 2 questions per participant and come back in the queue for a follow-up. The next question is from the line of Devansh Advani from Baazar. Please go ahead.
Hello.
Yeah, hi.
Yeah. Congratulations on good set of numbers. So what sort of numbers do you see going forward in Q2? And also, what is your guidance going forward as far as top line and bottom line is concerned for FY26?
So we anticipate a stronger upcoming quarters, with our guidance of revenue will be around 25% only till the time Q2 concludes. I think post that only we will see if we want to revise the guidance or not. And in terms of EBITDA, at pre-Ind AS it's around 7 to 8%, and at PAT it's around 3 to 4% as a guidance.
Okay, all right. Thank you.
Thank you. The next question is from the line of Vidisha Seth from Ambit Capital. Please go ahead.
Hi, good afternoon. I just had one small question, and I'm not sure if it's repetitive in nature. But can you help us understand the differential between the sales per square feet in metro and tier 1 cities versus tier 2 and tier 3 cities?
to have a higher per square feet sale. So for maybe for just on an average, if I tell you, so the metro and tier 1 cities on an average would give us a SPSF of more than 12,000 per square feet, whereas maybe tier 2, tier 3, tier 4 average will be around 8,000 or 8,500. Exact numbers I think we can take offline, but yeah, that is the numbers that we are generating from metro tier 1 and tier 2, tier 3.
Got it. That's helpful. Thank you. That's all.
Thank you. The next question is from the line of Deepak Podar from Sapphire Capital. Please go ahead.
Yeah, am I audible?
Yeah, you're audible.
Yep. Thank you very much, sir, for this opportunity. So just first up, I just wanted to understand, what's the gross margin difference between private label versus other brands?
It's majorly around 1.5% as a difference.
Also, I mean, it's not much then. I mean, gross margin difference is only 1.5%. That's what you're saying.
So basically, see, right now, our aim is not to increase margins. Our aim is to stabilize our brand, because it has been post-COVID only when we started this journey, and we are at 61% sales as of now for this quarter. Our objective is that higher will be the sales in private label, more will be good, the better will be the experience of customers with the private labels, higher will be sale in the future, where we can work on improving the margins over there also. So right now we are just seeing that the margin should be in the similar lines with the other labels, so the private label gets that competitive advantage over other labels.
Okay, I understood. And so you mentioned about this year's pre-Ind AS PAT margin of 3 to 4%. Now, Can you suggest something on the post-Ind AS as well? What sort of a range we are looking at?
So yes, 14 to 15% will be the EBITDA margin, and PAT margin will be between 2 to 3%.
Okay, but given the run rate of interest and depreciation we are currently having because of all these lease liabilities, at 14-15% EBITDA margin, it will be difficult to achieve 2 to 3% of PAT margin, right? At 25-26% kind of a tax rate.
No, I think we will be able to achieve between 2 to 3% with the numbers that we have prepared, and I think with all the assessment and working that is going on, we will be able to achieve this number of 2 to 3%.
2 to 3%. And when we said 4 to 5%, I think PAT margin in FY27 in the previous call.
Correct.
So we meant pre-Ind AS or what?
Yeah, so for the discussion purpose, we only talk about pre-Ind AS because that is, I think, the most accurate way to look at the numbers. So yeah, it was pre-Ind AS only.
Pre-Ind AS. And just one final small thing. Given the kind of store growth we are seeing, and even the SSG is quite good. So a 25% CAGR, over next 2-3 years is what one should look at a company level for us?
Yes, 100%. 25% is the number. I think it's a balanced growth approach, which will help you in sustaining the margins also, and having a healthy profit bottom line.
Fair enough. That's very helpful, sir. I would like to wish you all the very best. Yeah, thanks so much.
Thank you so much.
Thank you. The next question is from the line of Arvind Arora from A Square Capital. Please go ahead.
Hi, congratulations on good set of numbers. My questions are mainly you are saying your revenue guidance would be same for the current year, like it's 25%. So, could you please give us a breakup on SSG growth, what you are expecting?
So see, quarter one we have grown by 37% as a revenue growth. For the full year it is around 25%. The revise, if anything we have to revise, we will take this call after the first half of the this financial year. In terms of SSG, it is around 7 to 8% as a guidance for this year.
Okay, same like what you alluded on quarter 4, correct?
Correct.
Okay, and so current quarter, despite the SSG growth SSG is in negative, we still are paid positive. So can we assume same for the remaining period as well?
Yeah, for this all the remaining quarters we can expect the same.
Okay, thank you. That's all from my side.
Thank you. The next question is from the line of Ashwin Kedia from Alchemy Capital Management Private Limited. Please go ahead.
Hi, congratulations on the superlative growth. I had two questions. One was, how many of your focus markets will move to core markets? That was the one. And second, we've hired somebody in the supply chain. So how do we see our warehouse capacity and the supply chain growing and technology?
So coming to your first question, in terms of focus markets, see, generally it is the number of stores and the time that we spend in the market on which we take a call whether it has shifted from focus to core. For us, UP and Jharkhand are the two states where we are focusing very much, and I think in coming 2 years they will shift from focus to core as a state. Because with the larger number of stores opening in those areas and with the better knowledge about that catchment, we are able to achieve good margins, and I think there's a huge potential also. So that will be the focus areas for us. In terms of warehouse, yeah, we have hired a lot of good people from a big national chains on the supply chain, and with the technology in upgrading our infrastructure in the warehouse with the Infor coming as a warehouse management solution by November. I think by this year end itself, the warehouse will be very highly upgraded by this year calendar year itself, and maybe in the next year the entire benefit of the supply chain will start passing on to the stores, which will again will be showing in the bottom line.
That's great news. I have one more question. Any numbers you had in mind for UP, Jharkhand? How many stores you have mapped, places, how many they will grow to next 2 or 3 years, UP and Jharkhand?
See, in terms of not directly as a number, but what I can say is that 30% of the stores are opening in the focus market. So, for example, in 22 stores that we have opened in Q1, around 7 stores have been opened in the mix of UP, Jharkhand, and other focus states. So that will be the ratio for this year. And post this year, again, we will have an analysis on where to open the stores. Maybe the next year, the numbers may look higher for UP.
Thank you. Wish you a great festival season. Thank you so much for answering questions.
Thank you so much.
Thank you. The next question is from the line of Shubhanu from 3 Head Capital. Please go ahead.
Hello.
Yeah.
Am I audible?
Yes.
Hello, sir. What is the ASP in Q1FY26?
Pardon?
What was the ASP in Q1FY26? Hello.
I think some disturbance on the voice side. I'm not able to get your question. Can you come again?
What is the ASP in Q1FY26?
Okay, ASP, average selling price for the Q1 FY26.
So it is around 267 for Q1 FY26.
In FY25?
It was 286.
Okay, my other question is, one of us PRs called V2. Their ASP also similar lines, but they are same store sales growth. Sorry, they are average. Hello. Am I audible?
Yes. You are audible, but your voice is not clear. There is some disturbance coming in, so the question is not very clear. If you can just be a little clear and loud, so we can answer your question.
What is your guidance in sales per square feet going forward?
So on an average, with 7 to 8% as a SSG guidance, I think we expect overall revenue to grow by 5% every year, and in next 2 years we expect our numbers to reach around 10,000 rupees of SPSF.
10,000 next 2 years. Next 2 years. Hello.
Yeah, next 2 years. So 8654 was the FY25, and with 7 to 8% SSG, and with the stores that we are opening, we expect in by FY27 we will be somewhere between 98 to 10,000 rupees of SPSF.
Okay. Thank you.
Thank you. The next question is from the line of Yash Tawani from Amara Capital. Please go ahead.
Yeah, hi. So just wanted to understand, like, what levers are we working on to increase the sales per square feet, like, in terms of, like, what is the target that we are seeing over the next 2 years, and what is the strategy and the levers that we are working on to increase the sales per square feet in our business model? Yeah.
I think first thing is on the product side. We are working a lot on the product, and I think we want to maintain the name value. So I think we are doing everything that average Indian wants. So they want a high perceived value item at an unbeatable price point, and we are working on that. So the product is I will say, the most important lever that we are working on. Apart from that, the assortment. So what we need to keep in which stores, we are working on that also, with lots of technology that we are building at the back end, which will help us to have a clear understanding about the catchment, and so that we can create a assortment in a manner which that particular zone wants. For example, the athleisure category has been very popular post COVID, and the sales of this track pants and this t-shirts of athleisure wear has increased, but metro and tier 1 has a higher contribution compared to maybe tier 2, tier 3. So what kind of assortment that you want, what kind of product category that you want to add, that is on which we are working, and I think with that we will be able to achieve this SPSF.
Okay, and are the gross margins similar in all the categories, like the sportswear and compared to the casual wear or the ethnic wear? Is it similar across the category or it differs?
So it is a little bit different, but not a very high differences between all of them. It depends on the price point also. So maybe the first price point, which we call entry price point, may have a little lower margin compared to popular and premium price points for any category.
Okay. And anything on the data management side, like what consumers are sensing in the stores, and how we can give more of their like what they are looking at in terms of data management to leverage the data and get it converted into monetized into sales? Anything on that sort of thing are we working on?
Yeah, so the second thing was the consumer. I just missed on that. First was the product, second was the consumer side. So we are working on that also. So we have got a more than 1.2 million database, and on which the entire team, there's a separate team which is working on that data sets, which works on what is the recency, how many times a customer has visited to your stores, why they have not been visiting to your stores, to create that couponing offers for those people, and to make sure that they come again back to the store. So there is a lot of work going on that also at the back end.
Got it. All right. Thank you.
Thank you. The next question is from the line of Ashish from Leo Capital. Please go ahead.
Yes, sir. So I had one question. The question was, how much is the inventory per store, and what percentage of our inventory is more than 1 year?
We generally follow more than 2 year system. So we have a 2-year cycle that we follow as a policy, and more than 2 years is around 2%, which we get liquidated, but maybe in next 3-4 months only. So that is the structure that we follow. So every up more than 2 years is around 2% only.
But so can you give the number for 1 year old also?
So as per policy, we follow this number only, so I can share that number with you right now. And the second question, that in terms of store and the total inventory mix, it depends on season to season. As I said, the total inventory for 31st March, before the festival season, it was around 2,700, which came down to 2,092 as on 30th June. So similarly, 80 to 20%, 80-20 ratio is between stores and warehouse in terms of inventory.
Okay. Thank you, sir. That answers the question.
Thank you. The next question is from the line of Asta from Picadey Advisors. Please go ahead.
Thank you, sir, for giving me the opportunity. Sir, my first question was related to the competition. So we are saying our competitors are also increasing the number of stores, like their target is 100 or 100 plus they are expanding in the same region. So how are we seeing us versus the competition?
So I will want to give you this answer in the two parts. First thing, if you see at the macro level, everyone is doing well. Even the competition is doing well. Okay, so market is good enough for everyone. And the major reason behind is that we had told in previous call also, the organized penetration is very less in tier 2, tier 3, tier 4. Rather, only maybe 3 stores of organized players are only there in a particular small district or town as of now also. So there's a huge room. Now coming to us, we are working on tech, we are working on product, we are working on store ambience, we are hiring good talent just to ensure that the customer experience is best among all the retailers who are in our competition. So we are trying to work on all this stuff to have an additional advantage over our competition. And even if you see the numbers, whatever numbers that we are targeting, we are able to achieve that number. And as I said, the major reason is unorganized to organized shift. Second thing is the product. In couple of years post COVID, the product quality has improved significantly with the higher MOQ that we have received, minimum order quantity that we are able to give it to the vendors, and with all the designing team and the good merchandiser coming into the system, we have been able to create a lot of fashion which we were not able to do it before COVID. But now I think there's a lot of under trading also happening. So people who want to look good but they want a reasonable price are shifting from mid-segment brands to us, that we have seen in metros and tier 1 also.
Right. Got it. So my second question is, what is the SSG of the oldest stores that have been active, like older than 2 years?
So for us, 18 months is a criteria that we follow for L2L growth, and for more than 18 months, as I said, last year we have done 12.79% for the full year. This first quarter it's around -3%, mainly because of preponement of Eid. But for the full year, we will be able to do 7 to 8% of SSG.
Okay. And sir, considering that now the festival season is gonna come, shouldn't our gross margins should improve rather than giving the just full year guidance of 50 basis points? Like for Q1 it improved by when Q1 it improved by 300 basis, even though there was no festival season or anything. And now then in Q2 and Q3 we will be seeing the festival season. So there will be scale of operations and everything.
So what happens in Q2, Q3, as I said, we will not be having a lower margins from last year, quarter on quarter, but it will be on the similar lines. With the festival taking place, there are a lot of offers and promos that goes on, ticket size offers, and there are a lot of which directly have an impact on gross margin itself. So there will be no rise in gross margin for Q2, Q3, but with the for the 3% the advantage that is in Q1 will translate at the year end to 0.50 bits only. That is the reason I am saying that Q2, Q3 will not have a lower margins, but it will not be having a higher margin compared to last year of Q2 and Q3. Because we will be passing on to a lot of that margin to the consumer just to retain all my customers.
Okay, sir. Thank you so much.
Thank you. The next question is from the line of Hitendra Pradhan from Maximal Capital. Please go ahead.
Hello, sir. Thanks for the opportunity. I hope I'm audible. So my question is with regards to the inventory management system. So what do you do with your older inventory? Like you have 2% of inventory which are more than 2 years old. So do you keep it in the your back-end warehouse, or do you transport it to central warehouse and distribute it? What is your strategy around that?
Generally, the entire inventory, the how the life cycle work is that for the first 2 years it is sold through stores. Post the 2 years, if there is any leftover, which is 1 or 2%, that comes to the central warehouse, and from where the scrap sale happens. At a very lower.
Do you keep any provisions around the older inventory?
So yeah, we have a provisioning policy around older inventory, and we maintain that.
Okay, sir. Okay. And sir, second question is with regards to your mature to new store mix. So what is your current mature store count?
For the L2L growth, I will just update you how many stores are there.
145 stores are L2L stores, SSG stores, which we speak of.
Which is a mature, you can say.
Okay, sir. And sir, on the mature store, as per your guidance and the numbers, if I calculate, the EBITDA margin at a store level comes around more than 15%. So would that be a fair assessment, or am I overestimating?
No, so your estimation is correct. Mature stores gives typically between 14 to 16%, and for the full year, on an average, it gives around 15%.
Okay, sir. Thank you, sir. Thank you.
At pre-Ind AS EBITDA.
Thank you. Ladies and gentlemen, in the interest of time, we will take last three participants. The next question is from the line of Arman from Blue Sky Fintech. Please go ahead.
Yes, sir. First of all, thanks for the opportunity and congratulations for good set of numbers. My question is generally on our strategy because, like we said, our rental increased because we opened in areas of Tier 1 and Metro, and at the same time, we also told that there is an underpenetrated market in Tier 2 and Tier 3. So, what's the strategy of going forward? How many stores will be opened in Tier 1 and Metro, and how many stores will be opened in Tier 2 and beyond? Also, currently of the 232 stores, how many are in Tier 1 and Metro? And similarly, Tier 2 and beyond.
So in terms of strategy, what we have done is a cluster-based thing. So when we say cluster, it's a state that we are clustering. So Metro and Tier 1 are opening only in those states where we want to form that cluster. So for example, Bengal is a state, so that will have higher Metro and Tier 1 count going in because we have got a good experience in a state as a Bengal, and we are opening a lot of stores. We want to capture the entire market of Bengal. Because that was the thing that we have seen in last 2 years. Even Metro and Tier 1 is giving us a phenomenal growth, and both in terms of revenue and profitability. So we want to stick to that structure. We are not going across India. We will be going by state approach. Wherever we want to have a higher number of store count, we will go in Metro and Tier 1. So it's a mix. Now coming to the assortment mix, how to decide. So in that scenario, it's not a decision. For example, the 40 stores that I am going to open, last year, luckily we got a lot of stores in Metro and Tier 1. So the mix of Metro and Tier 1 was higher compared to any other year. Maybe this year, I think the ratio will be again 75 to 80% are Tier 2, Tier 3, 4 only. Metro and Tier 1 typically is around 20% only. Last year was the only year where we got a lot of store expansion, particularly in the region of Bengal. As a result, we were able to open more stores in Metro and Tier 1.
Okay,
so strategy would be to go to states.
Yeah. So safely we can assume that 75 to 80% of the stores now we are going to open in this year or maybe next year will be in most likely in Tier 2 and beyond. So what is the current status of 232 stores?
So 51 stores is in Metro and Tier 1.
Okay. And is there a payback period difference between Tier 1 and Metro and Tier 2 and beyond? Because our average revenue is different, right? 12,000 and 8,000. Definitely rental cost will be also different. So is there any payback period difference?
It's almost on the similar range because the SPSF is higher, but again rental is also higher in those areas.
Yeah,
so typically,
exactly.
in terms of EBITDA, if I say, so when the store gets mature, so Metro and Tier 1 gives you a EBITDA of 13%, whereas Tier 2, Tier 3, 4 gives you a EBITDA of 15%. But again, the SPSF of metros are higher compared to that. Yeah. So in absolute value, more or less similar numbers only, 15 to 18 months, maybe 2-3 months up and down.
Okay. Thanks a lot. That's it from my side.
Thank you. The next question is from the line of Chirag from Keynote Capital. Please go ahead.
Yes, thank you for the opportunity again. Sir, you have mentioned that we would be opening 45 to 50 stores in this FY26, right? Yes. And our capex per store is around 2.5 crores. So, as you said that capex for FY26 would be 90 to 100 crores. Just wanted to understand how much are we spending separately for tech, warehouse, and store addition, if you could provide these numbers.
So 2.25 is not the capex, it is including inventory. It is the cash flow that goes in when we are opening stores. In terms of capex, it is around 1.1 crore to 1.25 crores. In terms of tech expenditures, we are planning to have 20 to 25 crore investment going in the technology side this year, which includes the upgradation of our warehouse also.
So, if we add 40 to 50 stores, still it would be requiring more than 20-25 crores of the amount that you are telling about the capex guidance for 90 to 100 crores. So just wanted to understand what can be our CFO expectation for after lease expenses for FY26 then?
In terms of expenditure, 50 to 55 crore will be in the new store opening, 25 to 30 crore will be in the warehouse infra and technology upgradation, and 10 to 15 crores will be on the renovation of the older stores. So typically that is the breakup of this entire 90 to 100 crore.
Right, but we would also require inventory, right? That one.
So in terms of inventory, whatever measures that we are taking, I think there will be, the way we see the inventory moving around, I think the inventory part we will not be a very high I will say investment that we have to do, because we are optimizing an inventory, and that is helping us to grow. So for example, on 31st March, the absolute value of inventory was around 521 crores, which has come down in the June to 442 crores. And I think the way we are seeing the inventory in coming FY27, we expect the inventory to remain anything between 550 to 560 crores only. As a result, only 30 crores of inventory will increase in 1 year time, whereas 45 stores will open. So that is because of the inventory optimization, which is happening because of all the tech things that we are doing and all the manpower that we are hiring. So we are able to improve efficiency on the supply chain on the inventory side.
Wonderful to hear this, Shyam sir. It's great expectations to be built on. Second thing I wanted to know, that when you are talking about 7 to 8% as SSSG, are we talking it about on a normalized basis, or we are talking about after Q1 negative 3% SSSG?
After Q1 negative 3%. It's nothing normalized. It's just an annual level. So after testing -3, it will be for the entire year we will be at 7 to 8%.
Fair enough. Last thing from my side, could you just provide me, if we have a size of design team in-house, what would be the size? Hello.
Can you come again with the question?
I'm asking, if we have any design team in-house, what would be the size?
So for the entire, our buying and merchandising team comprises of designers, merchandiser, sourcing guys, and all together as a collective team they work. The total team strength of them is around 70 to 75 people as of now.
Okay, that is it from my side. Thank you so much.
Thank you.
Thank you. The last question is from the line of Natik from NV Alpha Fund. Please go ahead.
Hi, sir. Thanks for taking my follow-up. So my question is, when did the warehouse cost or the warehouse rental started kicking in for us, when we moved from 80 lakh square feet to 1.6 lakh square feet? And is all of this in Kolkata itself?
All of them are in Kolkata itself, and it started from the July last year. So till Q1, it was 86,000 warehouse that which we were operating, and from July it was 1.86 lakh square feet of warehouse which we were operating.
Right. And so my second question is, any plans to open warehousing space apart from West Bengal also, as we are expanding into the north more now?
So in terms of planning, not right now, but as we open more stores in the north and the clusters, so we will also have this type of model where there will be regional distribution centers going ahead once the number of store count increases on any particular zone.
Thank you. Ladies and gentlemen, that was the last question for today. I now hand over the conference to management for closing comments.
Thank you all for making it to our quarterly earning call for Q1FY26. If there is any further queries, please feel free to reach out to Stellar IR Advisors. Thank you one and all. Have a nice day.
Thank you. On behalf of Baazar Style Retail Limited concludes this conference. Thank you for joining us, and you may now disconnect your line.